Let's talk about those numbers and more now. Martin Smith from Anchor Capital joins me. Martin, as always, thanks for your time. Let's speak about the overall markets and their performance this week. It was quite volatile, sometimes in the red, sometimes in the green, but we've had a relatively positive close. What were some of the catalysts?
So there's a lot of things going on at the moment. As you mentioned, we've had a really good rebound after quite an aggressive sell-off, both globally as well as locally. So, I mean, there's a lot of nervousness in the market, and I think we've spoken about it a few times, about that kind of seesaw of growth and value and risk on and risk off. And I think that just talks to the kind of direction the market's looking for. I mean, valuations are sky high in certain areas. And again, investors are just a little bit nervous. Anything that smells or looks or seems to have inflation linked to it, people get very, very nervous around. I mean, we saw Yellen had those comments out last week, Tuesday it was, speaking about interest rates kind of picking up, and the markets got very, very nervous. And the same was present this week on the back of those CPI numbers. But the Fed have been saying it again and again and again, that they think inflation is transitory and that things will normalize and that we won't see rates increasing anytime soon. So again, I think it's more nervousness and a bit of emotion coming into the market. But I think the seesaw's tipped again in the favor of people being a bit optimistic. And I think we'll see that continuing for the next few months. And I think that's definitely going to be a theme.
Right, let's move on to some company news now, Martin. TFG flagging that profits are likely to decline by up to 85%, and this is because of COVID-19. I mean, I knew it was bad for clothing retailers, but I didn't think it was 85% bad.
Yeah, I mean, we've got to remember they are absolutely in the eye of the storm. But if we have to look at those results kind of holistically, I think we'd say it's pretty mixed. So while earnings disappointed versus consensus, the big and most important thing for me was looking at their balance sheet. They paid down a lot of debt. That balance sheet looks very, very healthy going forward. And I think the name of the game at the moment is kind of having a very healthy balance sheet. We've seen a lot of companies recapitalize over the last, call it 6 to 12 months. And TFG is one of them that's looking in good shape. Their outlook statement was also very, very positive. As you know, markets are forward-looking. So I think at the margin, I think it's quite a positive set of numbers, even though a little bit mixed in certain areas. And I would be inclined to actually have a little bit of a nibble and start to buy some of these shares. As you know, I'm quite positive on Mr. Price. That's my preferred pick in the sector. But I wouldn't not be buying TFG here.
Would you have a nibble of Sasol? I mean, one of the latest that's coming out of them is they're selling off some assets. What do you make of the moves that they're making?
So, I mean, it's still crazy to think that this was a 25 Rand share, called it 14 months ago. But, I mean, it's been very well flagged, this asset sale and kind of self-help story with Sasol. So, I mean, they were looking to raise anywhere from $4 to $6 billion in a bid to, again, shore up their balance sheet and kind of pay down the debt. At this moment in time, they've done about $5.1 billion. So while this is a positive piece of news flow, because they're going to raise between 4 and 5 billion Rand from the sale, I think the trick's already been played, and the market's fears of a big kind of capital raise have been slightly kind of abated. So I think at the margin, positive. But again, Sasol, balance sheet's in good shape. A lot of earnings momentum. We've seen what oil's done over the last few months. I'd be buying the share here.
Right. And then finally, Martin, Redefine Properties deferring a decision on that interim dividend payout until the release of the annual results in November. Your thoughts on that?
I feel like a bit of a broken record, and I'm going to say balance sheet again. But it does come down to that. So if you look at the loan to value of Redefine, it's about 48% at this moment in time, which is a little high. So I think a lot of the property stocks need to be prudent in terms of liquidity and solvency. So I think Redefine have taken that same sort of stance. I mean, they came out with the trading update yesterday, said they'd wait to see if they're going to defer the dividend or not. We thought that they would, and they kind of followed suit. So I think it's probably the right call. But again, the massive LTV, well, not massive, but the 48% LTV on the stock makes me think I'm happy to kind of sit on the sidelines.
Martin, as always, thank you for your time. That's Martin Smith wrapping up the markets week that was.